Whether you're an entrepreneur just starting out, a student hitting the books, or an auditor in the field, there are two documents that tell the real story of any business. Today, we're going to break down the core difference between a balance sheet and a profit and loss account. So let's dive right in. Hey everyone, and welcome to the Audit Guidebook. I'm glad you're here. This explainer is Module 5 of our accounting series, and it's specifically designed to give you a really solid foundation in these key financial concepts. Thanks for joining us. So here's the big question. With so much going on every single day, how does a business cut through all that noise to actually understand and report on its financial health? Well, the answer is found in two absolutely essential financial statements. First up, we've got the balance sheet. And honestly, the best way to think about this is as a financial snapshot, like you're taking a picture at one very specific moment in time. The balance sheet, which you'll also hear called this statement of financial position, shows you what a business owns and what it owes. But the most crucial part of this definition, the part you really need to remember, is the timing. It's all captured at a single point in time. It's like a financial photo taken at the stroke of midnight on December 31st, freezing that one single moment. Now, at the very heart of the balance sheet is a fundamental rule, the bedrock of all accounting, the accounting equation. It says that a company's assets, everything it owns, must equal the claims against those assets. And those claims come from two places, liabilities and the owner's equity. It's not a suggestion, it's a law. It always has to balance. So let's break that down, right? Assets. Those are the valuable resources the business controls, like cash sitting in the bank or the machinery on the factory floor. Then you have liabilities. These are its debts, what it owes to outsiders, like suppliers or the bank. And finally, equity. That's what's left over. It represents what the business owes to its owners. It's their claim on the assets. Here's how it works in the real world. On the left side, you can see total assets of $16,000. Now, look over to the right. Those are the claims against those assets. We've got $4,000 in liabilities and $12,000 in equity. Add them up, and what do you did? Yep, $16,000. It's perfectly balanced. So always remember this core idea. The balance sheet is a static picture, a financial snapshot that tells you a company's exact position on one specific day. And this is so critical for someone like a lender who wants to see the company's assets available as collateral right now, not last year. Okay, so if the balance sheet is a static snapshot, how do we see the action? How do we know if the business is actually doing well? That brings us to our second key statement, the profit and loss account. This isn't a picture. This is the financial movie. The P&L, which you'll probably hear called the income statement more often, measures financial performance. And notice the huge difference from the balance sheet. This statement covers a period of time, like a month, a quarter, or a full year. It shows the results of everything that happened during that entire period. And to find out if a company was profitable, the formula is super straightforward. You just take all the money it earned, that's your revenue, and you subtract all the costs you had to pay to make that revenue, those are your expenses. What's left is either your profit or your loss. Let's look at another simple example. This company generated $20,000 in revenue from its sales. To do that, though, it spent $13,000 on things like rent and paying its employees. So you subtract the expenses from the revenue, and you end up with a net profit of $7,000 for that period. That tells the story of their performance, which is exactly what a potential investor wants to see to figure out if the company is growing. So just remember that analogy. The profit and loss account isn't a single moment. It's the highlight reel. It's the financial movie showing how a company performed over a period of time. So we have the snapshot and we have the movie. But where does the data for these reports actually come from? Let's take a quick look under the hood at the accounting engine that powers them. It all starts with the general ledger, or the GL. Think of this as the master book of accounts, the system's backbone, where every single financial transaction, every sale, every payment, every purchase is recorded and organized. It's the source of truth. Now, before you can just whip up those final statements, accountants have to perform a critical quality check using something called a trial balance. This is an internal report that pulls all the balances from the general ledger just to make absolutely sure that your total debits equal your total credits. It's an essential step for catching errors before the official reports are created. So the accounting flow is actually really logical. First, transactions get recorded and posted to the general ledger. Next, A trial balance is prepared to verify that everything is mathematically sound, and only after that verification step do you create the final balance sheet and P&L statements. All right, let's bring it all together and summarize the key differences one last time. The difference really comes down to position versus performance. The balance sheet shows the company's financial position, its assets, liabilities, and equity, but only at a single point in time. The P&L, on the other hand, shows its financial performance, its revenues and expenses, over a period of time. Two completely different jobs. So, let's recap the big ideas. The balance sheet is the snapshot of financial health. The P&L account is the movie of financial performance, and both of them are built from the data in the general ledger, right after being checked for accuracy by the trial balance. If this explainer helped clarify these concepts for you, please do us a favor and take a moment to hit the like button and subscribe to the Audit Guidebook channel. We have a whole library of content just like this, designed to help you master all sorts of accounting and auditing topics. And I'll leave you with a final thought to ponder. To get a true picture of a company's health, what do you think matters more? Its current financial position from the balance sheet or its recent financial performance from the P&L? It's a great question, and you know what? The answer often depends on who is asking. Thanks for watching.